Thank you, Andreas. And thank you. I just want to echo Eric's comments. Thank you to all the organizers for making this event happen. I know we probably all wanted to be in Santiago, but it's fantastic to be here virtually. And I very much look forward to the discussions over the next 2 days. So thank you. And thank you to the committee for selecting my paper for the conference. And if Andreas, if you could just give a thumbs up if you can see the slides. Perfect. Okay, great. Thanks so much. Okay, so I have 30 minutes and I'll be presenting my paper on bank foreign currency hedging and the impact of covered interest parity and emerging market perspective. I'll just say the usual disclaimer. The views in the presentation are those of myself, the author, and not necessarily reflective of views at my institution, the Banco de Mexico. Okay, so let's see if there we go. So in the presentation, I'm going to go through, I want to set up the research question and a little bit of the motivation, although this is a very relevant topic for the conference, so I won't spend too much time on that. Then I'll look at the data that I use and my approach. And there are two sets of results that I'm going to focus on in the presentation in the time that I have. I want to show you some results where I'm analyzing a panel of emerging market currencies. And then I will spend some time on results that dig deeper using data that I have access to that are for Mexico. And that data is granular, it's at the bank level. And so there are several hypotheses that I can test with that data that it's challenging to test with the emerging market currency data. And then I'll conclude, and I very much look forward to the discussants' comments. Okay, so first the motivation and the research question. As Eric mentioned, this work, it was a year ago when we sort of were drafting these papers, and so the motivation was external vulnerabilities, and as you said, this is as important as ever. And we, since the global financial crisis, we know across many metrics that banks and firms are increasingly using external funding sources. We also know that most emerging economies have flexible exchange rate regimes, and so vulnerabilities that arise from currency movements are of first order importance. And in the literature already, it's well established that banks and firms can experience negative balance sheet effects from any, for example, currency depreciation. So this setting means that there's a need to have hedging contracts or a need to hedge currency exposures. So that's really the broader motivation. So what's the policy context? Most of the financial stability policies in different jurisdictions take this into account. And there may be restrictions on bank balance sheet currency mismatch. For some jurisdictions, these regulations have been in place before the global financial crisis, but even post-global financial crisis, there's an awareness of this currency mismatch issue. So the banks use hedging to manage, if they have currency mismatch, they can go to the currency markets and hedge that exposure. So where does covered interest parity come in? Covered interest parity is important because that condition is, if there are some deviations from covered interest parity, we can see that there are some frictions in the currency markets, and the cost of hedging is not perhaps as efficient as we might like. So focusing on covered interest parity deviations is directly related to understanding frictions in those currency markets. So that's kind of the broader context for the paper. I'm going to now throw up a couple of charts, and I'm borrowing these. These are not in the paper, so apologies to my discussants, but I found these from the Bank of International Settlements. And I think they just set up a little bit of where I go in the paper on this issue of covered interest parity and the bank's role or effect on the foreign currency markets. So these are two graphs side by side. It's from the quarterly review of the BIS from December 2020. And really, I mean, what's perfectly notable is that there's a dramatic increase in both of these metrics. But I just want to point out that on the left, this is sort of a typical measure of external vulnerability. It's the emerging markets US dollar denominated debt, okay, as a percentage of GDP. And we can see that this has increased steadily from the time of the global financial crisis in 2008, 2009. So it was around 3 to 5%, and we're now around 9 or 10%. And if we extended the data more recently, it might be even higher. So that's a typical measure of external vulnerability, and we're all aware of other data that points to this development. What I want you to take out of the chart on the right, so this is the foreign ownership in emerging markets, local currency sovereign bond markets. Okay, so you see a rise in that as well. And this, in a capital flows framework, we typically think of this as a risk factor, increasing vulnerability to capital flights. So that's what we sort of have in mind when we're looking at this metric. But in the paper, I just want to tee up that the way I'm thinking about this is that those foreign investors, for whatever reasons, they have these positions in local currency bond markets. So they may want to hedge some of their currency exposure when they take that investment position. And so I set up in the paper this idea that maybe these foreign investors might offset some of the pressures from the resident agents who are on the other side of that. So what do I mean? I mean, the resident banking sector, they want to hedge their exposure to the US dollar, right? So they're interested in that side of the contract. But the foreign investors who are buying the local currency instruments, they want to hedge their exposure to the emerging market currency. So this is where I'm looking at the foreign participation in the bond markets a little bit differently than typical in our financial stability or capital flows framework. So I just want to tee that up and have that in your mind as I go through the paper. Okay, so let's move to the goal of the particular paper. So the first goal is just to document deviations in emerging markets, CIP deviations, and really try and focus on that sector rather than the developed market currencies, which dominate the discussion of this issue. The second goal is, if we do see deviations, which we would expect to see, do the resident banks have an impact on that deviation? So is there something about the resident bank behavior, in particular their need to hedge their currency mismatch, is that going to somehow impact the deviation in one direction or another? And the hypothesis is that they're going to widen that spread. They're going to widen the deviation because their currency mismatch is such that they're going to be on one side of that. So if we're widening the currency basis, are there any offsetting forces? So remember the covered interest parity, just as a refresher, the condition is that interest rates in different currencies should equate once you've accounted for currency risk. And usually the argument is that this should hold because arbitrages will come in if there's any differential, right? So we typically think that if there's some driver widening the basis, then arbitrageurs should come in and reduce the basis. So that's the typical candidate. But then I also want to think about these foreign investors, and maybe because of shifts in globalization and financial globalization, maybe there's this pool of foreign investors that might also be an offsetting force. So those are the three goals of the paper. And I'll try and get through some of the results in my time. So first, apologies for the spaghetti diagram. This is documenting CIP deviations for 10 emerging market currencies. And this is going to be the deviation at the 3-month tenor. And I chose these currencies based on BIS data to find the most commonly traded emerging market currencies, and also some data limitations. So there are 10 that I focus on. And what I want you to take from this graph is the dark blue line is Japan's currency, CIP deviation. And that Japan, or the Japanese yen, has been the magnitude of the deviations in that market has been a focus of discussion. So it's just in there to kind of give you a benchmark of where emerging market currencies fall in terms of the size and dynamics of the CIP deviations. So really the takeaway here is that yes, in emerging market economies, we also have CIP deviations. And so let's try and figure out what might be driving those. Okay, so in some the main question of the paper is whether the banking sector, the resident banking sector of the emerging economy, has an impact on the cost of hedging, which is the covered interest parity deviation. That's the proxy for it. So the main analysis is regression analysis, estimating a model where the dependent variable is the CIP deviation, and the right-hand side has some hedge measure, either the resident banking hedge measure or foreign investor hedging measure. And I do this in a panel of emerging economies, as I mentioned, and also an in-depth Mexico case study where I have supervisory data that I can exploit. And just in sum, to give you a preview of the results, there is evidence in both the panel and the case study that the resident banking sector's currency mismatch is associated with wider CIP deviations. And there's also evidence in the Mexico case study where I can identify foreign investor hedging that is the opposite direction. So it's narrowing the CIP deviation. However, even accounting for the foreign investor hedging demand, we still see that the resident banking sector is widening the CIP deviation. With the Mexico data, I can drill down and ask about different types of banks. And so I can identify what I call the global banks. And I'll talk a little bit more about that issue and the hypothesis around that. And there's evidence that the global banks are driving this widening effect. And then on the question of arbitrage or constraints, there's mixed evidence, and there's some results that may suggest that the experiences in emerging economies is different than developed markets. But in general, the arbitrage variables, nothing sort of leaps out from the results that is intuitive. So what is the contribution? The aim is really to focus on emerging market economies because there isn't work on that. And then there's the bonus of being able to exploit the bank level data from Mexico to test these additional hypotheses about foreign hedging demands. And then also this question about global banks. Is it driven, is it really global banks that are driving or having an effect in this foreign currency market? Okay, so briefly, and there's a lot of literature on this. So, I need to get the reference list, but I'm just putting up a few papers here. And the first 2 or 3 are really more theoretically oriented. And from those, we get this idea of the mechanism at work that I'm focused on with this hypothesis around global banks. So there are different contexts. The first one is about the global financial crisis and the behavior of European banks when they lose their US dollar funding. And so it's a credit shock for the banks. And then the second paper is about monetary policy spillovers and the low interest rate environment in advanced economies. And really, both of these results or these models rely on an increase in demand for hedging or currency swapping and hedging. And that increase leads to an increase in that cost, the cost of hedging, right? And so that mechanism is at play in those models. And so that's really why I'm interested in checking the global bank hypothesis. Is it them that's driving the CIP deviation, because that would validate some of the mechanisms in these models. And then the last few papers, and there are more empirical studies out there, these are trying to have a broader question of what's driving CIP deviations. And they include arguments like the post-global financial crisis regulatory regime. So as we know, there's been a big sort of regime shift in how banks are regulated. And this could be affecting their capacity or the incentives for them to participate in arbitrage. And then there's also questions of a story around the global financial crisis was whether the banks have access to US dollar funding and whether credit worthiness or counterparty shocks could be affecting this cost of hedging. So my paper is really drawing on these both for the hypotheses, but also for some of the variables that I include in the econometric model. Okay, so how to study this in the emerging market context? As I mentioned, most of the papers above look at G10 currencies with a focus on dollar, yen, dollar, euro, and yen. And so coming from Mexico, the Mexico peso I've done other work on the peso, and we really wanted to get a fuller understanding of what you can generalize from the G10 currencies and what you can't. And obviously, there's a lot of heterogeneity across policy regimes and across financial sectors. But the intent was to start with an emerging market panel. Obviously, I need a measure of the covered interest parity deviations. So I need these risk-free interest rates. And then I want to construct some measure of hedging demand. The resident banking sector is my primary goal, but then I also would love to have a measure of foreign investor demand, because the idea is that might be offsetting. So, and I'll go through how I construct those measures in the data section. And additionally, because traditionally in the CIP literature, it's not going to be zero. We know it's not zero. So what drives a little wedge in there, and we have transaction costs or liquidity costs. So those are going to be sort of bid and ask spreads. And then this argument about arbitrage or constraints, which is highlighted in the G10 literature. I've tried to bring in that to the model as well. Okay, so here's the model. It's very simple. This is in the panel setting. So the left-hand side is the CIP deviation for the country. And the right-hand side, the variable of interest, is the hedge variable. And in the country panel, in the emerging market currency panel, the hedge variable is only going to be the resident bank currency mismatch. So that's going to be the hedging variable of interest in the panel. And then the vector of variables X is going to include these other candidates for what would lead to a non-zero CIP deviation. And I'll talk through a little bit this arbitrage or balance sheet constraints, because that really speaks to the regulatory question, the sort of unintended consequences of the post-global financial crisis regulations. And there's other work on this in terms of market fragmentation, but there are two elements that are discussed in the literature. The first is the counterparty risk, which is from the European crisis. So the bank's creditworthiness, there's a shock to their creditworthiness, and so counterparty risk in the currency markets now becomes priced in to the trade, whereas before it may not have been. And also post-financial crisis, there's this issue of market risk for the foreign currency collateral in the arbitrage trade, and those can interact in various ways, but the market risk is basically the foreign currency collateral value is going to change, right, depending on where the market is going. So this is sort of, if you're from the banking literature, this is sort of the credit risk and market risk for this type of trade. Okay, and the hypothesis is basically that the coefficient on the hedge variable has some significance. So there's some effect from this hedge variable. And when I'm able to test for the foreign investor effect, that is my hypothesis is that's the opposite effect of the resident banking sector. So we have a negative basis. So the hypothesis is that the beta will be negative when the hedge variable is measuring the resident bank currency mismatch, and it will be positive when it's measuring the foreign investor hedging demand. And the alternative hypothesis is that these hedging variables, they're a wash and they don't actually drive the basis one way or the other. Okay, so on the estimation, we have this issue of endogeneity. So bank hedging demand or a foreign hedging demand, perhaps there's some reverse causality where the banks or the foreign investors see the basis and then they change their behavior based on that. I actually ran a whole bunch of regressions to try and find if there's sort of a reverse causality issue. I didn't find much. Nevertheless, there are other reasons why there might be endogeneity. So I use an instrumental variable approach, and the instruments are the lagged values of those variables. And then the other standard error adjustments are pretty standard. I also test for stationarity in the data. And in the panel setting, so if you saw in the model, there's a country intercept or country fixed effect. But I also try in the panel setting to get at this idea of financial sector development or financial sector heterogeneity. if there's a different structure in the domestic financial sector, for example, a larger presence of foreign banks or global banks, is this effect stronger? And so I try and get at that by using some other data to proxy for that, because for these jurisdictions, I don't have the individual bank data. Okay, so what data do I have? Bloomberg, I use the underlying data of Bloomberg to calculate the cross-currency basis, which is the measure of the covered interest parity deviation. As I mentioned, I'm using the resident banking sector, US dollar core assets minus liabilities. And this is from the BIS banking statistics. When they don't have US dollar, I'm using overall because they don't have a breakout. So it would be a foreign currency mismatch. And this is on the residence basis. So what does that mean? That means this currency mismatch is for all the entities within that jurisdiction. So even, for example, for Mexico, it includes Banco in my sample of the currency mismatch. Banco has a foreign parent, but it's based in Mexico. So that's the statistics that I'm using. And then because I do observe the bank level data in Mexico, I can look at the global banks currency mismatch. And I can also see from transaction data, I can actually see the foreign currency derivative positions with foreign counterparties. So from that data, I can construct a measure of foreign investor hedging demand. Okay, so those are the two hypotheses that I can test because I have this bank level data for Mexico. And then the rest is from Bloomberg and pretty straightforward. And I'll just point out the time frames for the studies. So the emerging market currency panel, I have data to use from March 2000 to December 2018. The data is more sparsely populated in the beginning of the sample. And then in Mexico, for the Mexican data, I have it from July 2013. That's when it starts to November 2017. So it's a shorter sample, and I hope I can possibly update that. I'm working on updating the data to get a longer time period. Okay, so I'll walk through some results in the time that I have. So quickly, I'm going to do two sets of results. The first is the emerging market panel, where I'm trying to see if the resident bank currency mismatch is having an effect on the CIP deviation. Because of data limitations, I'm unable to include all of those arbitrage variables that I had talked about. And so here I'm just showing the bid-ask spreads, which are kind of a proxy for liquidity or transaction costs in those markets, and the FX implied vol, which is basically the implied volatility in the currency market. That is a measure of the market risk to the arbitrager. So I do have that, and I'm able to include it. And what really just what I want you to get out of these two columns is, first, we have the hypothesized negative sign on the resident bank currency mismatch. So that means that higher levels of currency mismatch for the resident banking sector is associated with a wider CIP deviation. So that's sort of the key question in the paper, and from the panel, we get this evidence. There is not particularly compelling evidence in these regressions to suggest that the arbitrage or constraints are of key importance. So those are the two things I want you to get out of this. For digging a little deeper, I try and assess whether foreign banks or the presence of global banks has an effect on this dynamic. There is data from the World Bank that counts the number of foreign banks in the jurisdictions. So for the currency markets that I'm looking at, this just gives you a sort of an overview for the sample period. This is the average percent of foreign banks in as a percentage of the total number of banks. So I'm just showing you the average. There is some time variation in this variable, so there's a little bit of an advantage to using this variable. I also use a dummy variable for financial center, and the BIS has some work on identifying financial centers. and they identify in this sample the Hong Kong and Singapore as financial centers. And you'll see that that matches with this data because the two jurisdictions that have the largest percentage of foreign banks is Hong Kong and Singapore. So using those two variables, I try and get at this question of what is the role of the domestic financial sector, the characteristics of the domestic financial sector. So this, I'm just showing three results here very briefly, and there's more discussion in the paper. But again, we see that some evidence that the domestic resident banking currency mismatch, even if you're a financial center, it still has a widening effect on the basis. So you'll, in column one, the financial center dummy. So all of these regressions include country fixed effects. So when I add the financial sector dummy, this is just for Hong Kong and Singapore, what the level of the basis will be. And so it will be more narrow, right? So being a financial center, your deviation will be smaller. But even so, the domestic banking sector's hedging requirements cause this, are associated with this widening. And that's the negative coefficient on the hedge and the negative coefficient in column 2 when it's interacted with the financial sector. And then
Georgia,
lastly, yes,
Georgia,
how many minutes do I have?
You have 5 minutes.
Okay, great, thank you.
Okay.
My timer stopped working. Thanks so much, Andres. Okay, so, and then lastly, just using the foreign banks, we get some more evidence that this is widening. Okay, I wanna get to the Mexican case study because it gets into more detail. So from the emerging market panel, we have some evidence that resident bank hedging widens the basis. We also have some suggestive evidence that global banks or the domestic financial sector characteristics are relevant. In Mexico, in terms of the policy context, there's a currency mismatch policy. Your foreign currency mismatch has to be less than 15% of tier 1 capital. And that's been in place since the 90s. So there's no policy changes in this under the time period under study. And there's also a liquidity requirement around that. And I'll just say that this is not necessarily a regulatory constraint that binds. Inspecting the data, it does not seem like this binds. However, the banks they do have to be in compliance, and for their own risk management purposes, they're going to be hedging their currency mismatch. Okay, so in my 5 minutes, I'll just quickly go through this and invite people to consult the paper for more discussion. If you look here, I've done the CIP deviations for different maturities. And if you focus on the 3-month, which is the column with 3M at the top of it, you'll see that there's, again, a negative coefficient on the resident banking currency mismatch. It's true across all of those maturities, the short end maturities. Okay, and what about the foreign investor hedging needs? As I said, the foreign investor hedging needs are proxied by the observed FX derivatives transactions with foreign counterparties. And you'll see that as giving some support to the hypothesis, the hedging demand from the foreigners has a positive sign. So that means it's narrowing the negative basis. Okay, so what if we take a look at this global bank hypothesis? You'll see in column 1, the system-wide, that's the result I've already showed you for the 3-month. So we see the negative coefficient on the hedge variable for this whole system. So that's the entire resident banking system. Using the Mexican data, I can split out the global banks. And who are the global banks? The global banks are banks with a foreign parent located and operating in Mexico who have DSIB status. And DSIB basically means a domestic systemically important bank. So they fit the description in these theoretical papers of what a global bank is. They are intermediating in that jurisdiction. They have access to foreign currency funding, and they're creating assets in the local jurisdiction. So that's the set of banks that I then focus on, and I look at their currency mismatch. And you'll see that we still get the negative coefficient for the global banks. So global means global banks currency mismatch. And when we look at the system excluding the global banks, we still have a negative coefficient, but it doesn't seem to be a significant effect. And lastly, in column 4, I've taken the system as a whole. I've taken the global bank hedging demands and netted out the foreign investor effect, the foreign investor hedging demand. So I'm assuming from our earlier results that that's an offsetting force. We have sort of the remainder of demands, and that's the aggregate hedging column results in column 4. And again, we see that that's a negative coefficient. So even with for this time period, even with the foreign investor hedging demand offset, the banks are still associated with a widening of the CIP deviation. So that's sort of the key results out of the Mexico case study. I will, in the interest of time, I'll just sum up. So from the Mexico case study, we corroborated the emerging market panel study results showing that the resident bank hedging has an impact on the foreign currency markets and is associated with a wider CIP deviation. In the Mexican case study, the variables are standardized, so you can actually back out the magnitude of that effect, and it's around 20 pips. For the foreign hedging, it's positive, and it's 24 pips. And the interesting in terms of the theoretical literature, we see that the global banks are driving this effect. And there's something different about how the global banks interact with the hedging, the foreign currency markets. There's more in the paper about arbitrage or constraints in the emerging market context. There's some interesting results that are different than what is hypothesized in the advanced economy literature. I invite you to consult the paper. Basically, joint tests suggest that these variables should be in the model, but there's no sort of strong evidence that any of these are driving the CIP deviation. So just some caveats, because I know I'm running out of time. So the data frequency, this is month-end data, because balance sheet data we have at the end of the month. So that's that's the scale of the data frequency, which are caveats to that in terms of how we think financial markets respond and how we think balance sheet responds. So we're only capturing the activity at the end of each month. And also the policy that I was concerned of, or we were focused on, was the currency part of the balance sheet. So only the foreign currency mismatch is analyzed in this paper. But there are obviously very interesting questions about the overall balance sheets of banks and how they're responding to the regulatory constraints, not just are they switching out of some activities, and we might see that in the other parts of the balance sheet. And that's where other regulations may be important as well, not just the policies that we use to manage bank currency mismatch. Okay, with that, I will hopefully be on time, and I'm very much looking forward to the comments from these discussants. Thank you.